Good afternoon to everyone present here today. My name, like I said earlier, is Adiola Idowu, associate at Regfyl, and Regfyl is the one hosting today's session. I would like to introduce our distinguished panelists who graciously accepted our invitation to speak today. Our first panelist is Sanmi Lawal. So Mr. Sanmi Lawal is a highly accomplished enterprise compliance risk executive with over a decade of experience designing and leading enterprise-wide compliance, risk, and financial crime frameworks across banking, fintech, cross-border payments, digital assets, and capital markets. Trusted advisor to boards, executive management, regulators with a proven track record of building regulator-ready governance and control environments that strengthen institutional resilience, enable sustainable growth, and safeguard organizational integrity. He is adept at translating complex regulatory requirements into pragmatic business strategies that balance commercial objectives with effective risk management. He also possesses deep expertise in regulatory compliance, enterprise risk management, AML, CFT, CPF, sanction, anti-bribery and corruption, corporate governance, and operational resilience across multiple jurisdictions, including the CBN regulations, the MLPA, the TPA, the GDPR, UK Bribery Act, US FATF recommendations, OFAC, and FinCEN, recognized for leading regulatory engagement, licensing programs, governance transformation, policy architecture, and financial crime initiatives while building high-performing compliance and risk functions that enable organizations to scale confidently with complex regulatory environments. So please welcome our first speaker, Mr. Sanmi Lawal, to this session. Next, we have our second speaker, Mr. Eno-Obong Peter. He is a legal and regulatory compliance executive specializing in AML, CFT, financial crime prevention, and cross-border payment regulation. He currently leads legal, liaison, and regulatory compliance at JuicyWay, a CBN licensed cross-border payment and remittance platform operating across Nigeria, the UK, Canada, and the United States, where it helps shape AML, CFT policy and manages the regulatory relationships that keep the business compliant within Nigeria. He's a certified anti-money laundering specialist and a fraud specialist. Peter is also best known for leading multi-jurisdictional asset recovery, hands-on experience that informs his perspective on where fintech compliance meets real-world financial crime. His career spans regulatory compliance leadership across capital markets, microfinance banking, and payment services, giving him a rare cross-sector view of Nigeria's evolving financial regulatory landscape. Please welcome our second speaker, Mr. Eno-Obong Peter. Our third speaker is Mr. Emmanuel Abu. Mr. Emmanuel Abu is an experienced compliance and anti-money laundering professional with a strong focus on financial crime prevention, regulatory compliance, and risk management. With certifications including the DCP, the CAFs, he brings deep expertise in identifying fraud patterns, strengthening compliance frameworks, and supporting organizations in navigating complex regulatory environments. Emmanuel has demonstrated a consistent commitment to safeguarding financial systems through proactive monitoring, investigative analysis, and implementation of effective control measures. His experience spans working with compliance tools, handling fraud cases, and driving process improvement to enhance operational efficiency and regulatory alignment. Beyond his core role, Emmanuel is an active thought leader who shares insights on fraud tactics, compliance challenges, and risk mitigation strategies His work highlights the importance of balancing business objectives with regulatory obligations while fostering a culture of compliance within organizations. He's passionate about continuous learning and contributing to safer, more transparent financial ecosystems. So please welcome our third panelist, Mr. Emmanuel Abu. And just before we get into the panel discussion, I would like to welcome Regfyl's own CEO and co-founder, Dr. Babatunde Ibidapo Obe, to give us his introduction on what this session would look like from Regfyl's perspective and to basically just prepare us ahead. Welcome, sir.
Thanks, Adiola, and just permit me to just say thank you to Peter, to Sanmi, and Emmanuel for joining us today. I have had the privilege of engaging with all three of them independently, and I can guarantee everyone that is on the call today that you are in for the creme de la creme of insights from the people that are really on the front lines of what we're going to be discussing today. I won't bother you with such a long introduction because I mean, from what Adiola read, you can see that these people are raring to go, and these guys know what it is that they're going to be talking about. And so, from my perspective, I just wanted to kind of set set the stage. Firstly, I want to thank everyone who has joined the call. We intentionally wanted it to be a focused conversation from the people who experience the pain points that we want to be discussing today. This call, this roundtable isn't about Regfyl. Yes, we are the ones that are kind of convening it, but I guarantee you and promise you that we're not going to be trying to market ourselves throughout the course of this conversation. For us, we see this as part of our contribution to the development of the AML, the broader AML compliance and fraud prevention landscape in Nigeria. It is something that we are very passionate about. And as Adiola mentioned, we will continue to invest a lot in making sure that we allow these conversations to happen, whether this is through our State of AML report, whether it's through one of our offline events like our When Fraud Happens, or whether it's by supporting organizations like Comply First with these types of conversations. So that is our goal, and so I won't do any sales today. For me, a lot of the people that I'm just looking through the people that are in the audience. A lot of these we've engaged before, and thank you all for joining. I want to make the point that even though Peter, Sanmi, and Emmanuel are the people who are the panelists, the goal is we want collaboration and contribution from everyone. So their voice, even though the three of them are on quote unquote the stage, their voice is no less powerful than your voices. So if there are things that you want to engage on, things that you disagree with healthily, please raise your hand, indicate in the comment section. My team, they're going to be monitoring it to be able to bring people on stage to maybe challenge certain ideas or give their own perspectives. So it's meant to be a roundtable, and I see that we put executive webinar, but it's not a webinar. It's meant to be a roundtable for everyone to be able to discuss these issues that we're going to be discussing today. So on the first thing, I think we wanted to frame it from the perspective of the expectation of operating in the cross-border space. As you know, cross-border payments, they're always getting faster, cheaper in quotes, but everybody wants to stay more connected. And so every institution operating in that space is under pressure to keep up. Every other day you hear a new platform that is online, and then the legacy institutions are also still trying to keep pace. So there's a lot of tension that exists in the space, and that's why this matters. If you move money across borders, then there are additional obligations that are put on your institution, and there are additional expectations from regulators. And so as you can see from the center of the diagram, that is kind of what we're going to be focusing on. We're going to be focusing on speed, because ultimately everybody wants to get their money faster. So we're going to be focusing on speed. We're also going to be focusing on the idea of regulatory controls across borders. And we're going to be focusing on the relationship that you have to have with this correspondence banks and correspondence institutions. So it's from that framework that we're going to be discussing a lot of the things that the panelists are going to be double clicking on today. So across this, I think what we've seen is there's probably more than 3 tensions, but the ones that we want to focus on are visibility. Firstly, with respect to visibility, we want to know beyond your direct customer, do you have a line of sight into, for instance, the beneficiary? Who is the ultimate originator? Who is the beneficiary? Who are the intermediaries that touch the payment? One of the challenges in cross-border is that it is truly it can touch multiple individuals, multiple beneficiaries, and the farther the transaction goes away from the primary institution, the less line of sight, but it doesn't necessarily reduce your risk. So visibility is a big tension that we're seeing. Obviously, speed. The real-time payments, they compress the windows for potentially sanction screening, fraud alert investigation. And so the controls that have been designed for a specific type of framework might not necessarily translate to the cross-border environment. So the question is whether your screening, your decision-making process, your alert resolution can operate at the same speed of payment that is required. And then the third, I guess, tension that we see is around complexity. I spoke about the visibility around the originator and beneficiary, but in certain circumstances, you can see that a single payment can potentially touch 3 or 4 jurisdictions. Each jurisdiction has its own AML requirements, its own sanction regimes, its own reporting obligations, and also its own risk tolerance. Maybe one of them is on the gray list, maybe the others are not. So whose expectations should govern? Do you want to focus on the one where your primary operations are? Do you want to focus on the one that has the most stringent regulations? So, those are the tensions that we want to see discussed today. Specifically, what the panelists will explore, and we've given these topics as just guiding points. I expect that each of the panelists would have their own experience, and so if they want to move slightly away from some of these points, these pressure points, then they have that kind of editorial license to talk about the things that are concerning them. And so for the 5 pressure points that we've identified is what we call the payment speed trap. Faster payments mean less time to decide, and then obviously how do you reconcile that? The second is the regulatory fragmentation. So you have an IMTO that is licensed in Nigeria, but also licensed in Canada or licensed in the US, and we have a lot of customers like that have multi-regulatory exposure. So how do you kind of operate within that framework? The third is around correspondent banking. When you have a relationship with a correspondent bank, the expectation is that they'll give you a laundry list of documentation and things that you must have in order to establish that relationship. But it's not only about establishing that relationship, it's about ensuring that you don't lose that relationship. So what are the tensions and what are the pressure points around that? The fourth is around payment transparency. So as you know, the revised regulation 16 on the FATF travel rule, it's just kind of how are we in Nigeria, how are we implementing that, how are we thinking about it? And then the fifth and final one is around illicit financial flows. I was in a conference last week in Abuja talking about terrorism financing, and it's a big challenge that still exists so it's not just about money laundering, it's not only about proceeds of fraud or proceeds of crime, it's also about terrorism financing. So how do we detect illicit financial flows? How do we monitor? How do we screen? How do we investigate? Those are the things that our esteemed panelists are charged with stimulating conversations on. And so finally, what do we think you should take away? It's up to you what you take away, because ultimately, as I mentioned, this is a conversation amongst peers. It's not a presentation. It's not people who know more that are speaking to everybody else. It's everybody sharing their own ideas. But what we suggest that you frame as things that you could take away is around how risk concentration looks like in the space, around how you manage the tension between speed and control, around how you think about maintaining those correspondent relationships and how about watering and nurturing them, and how you think about payment transparency, and then ultimately what ideas you think you can take from this group to the day-to-day in your institution. I would hope that at least everyone should be able to take at least one new idea or one new challenge on how they kind of do their day-to-day. So yeah, that's it from me. Thank you so much. I'm looking forward to the conversation as well. I am not as skilled as Emmanuel and Peter and Sanmi on the day-to-day, so I'm really looking forward to engaging with everybody today. Thank you, and Adiola, back to you.
All right, thank you so much, sir, for that really wonderful introduction. And now moving to the panel. My first question is to all panelists, or starting with Mr. Sanmi Lawal. And so we want to know, just like Dr. Tunde has said, we want to know, the AML CFT risk in cross-border payment. We want you to tell us, across the cross-border payment lifecycle, where do you think this AML CFT risk is currently underestimated? Do you think it's at the point of onboarding? Do you think it's at the point of payment? Do you think it's within intermediary relationships, or is it at the beneficiary end, and why? So starting with Mr. Sanmi, and then Mr. Peter, and then Mr. Emmanuel. Please, we have 3 minutes to answer each of these questions. Thank you. Mr. Sanmi, please.
All right, thank you, Adiola. Good afternoon, everyone. And good afternoon, Doc. It's a great privilege to be on this panel. And yeah, good afternoon to my fellow panelists as well. So, yes, let's even start with the elephant in the room, right? What's the elephant in the room? Onboarding, because that's the first thing that you said, right? Onboarding answers who the customer is, truly. But in cross-border payments, it never truly answers what the payment chain does to that customer's risk once money starts moving, right? Because if you remember, during Tunde's presentation, he had said something around multiple players being involved in it, right? So cross-border payments are fundamentally different from domestic payments, right? So technically, what that implies is this: the risk that comes with cross-border is dynamic, it's not static, right? So you can onboard the client like very well. You can know everything you need to know about that client. But once the fund starts moving, so for context, the guy has given you local currency in Naira. There's somebody that you are relying upon to be your FX person. There's a correspondent bank. There's an intermediary bank. There's equally a payment service provider, right? And there's the beneficiary institution that the fund is moving to. Everybody at that touch point, as far as they have any role, either significant or not, to play, they add to the risk level of the customer in itself, right? Or of the transaction, as the case may be, right? And it's not average risk exposure. It compounds as it moves, right? Which is why global bodies such as FATF has equally stated that the monitoring effort has to be a continuous process. Like you are conducting your monitoring on everybody involved in the process. You are not treating onboarding as maybe a one-time thing. It's never a one-time thing, right? So with that said, there's equally the bit that seems underestimated generally, right? Which is payment context. Do you know what I'm saying? So there is, why is this payment even moving through this particular corridor, right? Does the payment path make any commercial rationale, right? As the routes recently changed without explanation, is value passing through multiple iris jurisdictions with no apparent justification? Because these are questions KYC alone was never built to answer, right? So the place where the risk actually concentrates, right, is whilst good onboarding tells you who the customer is, good transaction intelligence tells you what your customer is actually doing. And it is the second, right? So basically, it is good transaction intelligence that stops financial crime and not the onboarding in itself. So that's my response to that. So it's understanding the entire flow process, right? That gives credence to the transaction intelligence that guides how you mitigate all the risk exposures that the payment flow and whatnot add or aggregate into the transaction pattern in itself. So yeah, that's my response about. Thank you.
Good afternoon, everybody. My co-panelists, good afternoon. So just to build on what Sanmi has said, I want everybody to understand that the compliance framework, compliance in itself, it's always an evolving part of cross-border payments and financial institutions generally. For the life cycle of this, yes, we understand that AI has come to be in the system, but generally AI makes the onboarding framework easier, the spooling, the search, sanctions list, and the rest of it. But for us who are in the cross-border payment sector, the nested financial patterns that are involved in cross-border payments make it very, very delicate, because based on experience, you understand that even with your correspondent banks, you have to provide a level of compliance audited structure for you to be onboarded with them. That's one. But however, for your clients who want to initiate payments by themselves, the relationships are not always as straightforward as it should be, because for most of the times they are nested payers to other nested entities in themselves. So for you as a compliance person, you really do not know who the original initiator is, or neither do you have a very clear picture of who the beneficial owner of that funds is, who is the beneficiary of that fund. But so it's blurry to a large extent, and for us, it's something you need to always do your best to catch up with the intent of that, of whatever payment is being initiated, and because sometimes you look at it and you understand that even the paperwork for such payments are not properly presented. And for us in cross-border payments, we understand that trade-based money laundering is the most significant form of money movement in this sector, and all trades are mostly all transactions are mostly trade-backed transactions. So it's more blurry, more delicate when the intermediary relationships comes into place. And I think that is where there's a lot to be done in order to, get a structure, get a face, and understand where the initiator is and who the beneficiary is in order to curb either the money laundering or terrorist financing in itself. Thank you very much.
Good afternoon, everyone. Good afternoon, my fellow panelists. I would like to strongly build on what the two of them have said, right? Because risk is most severely underestimated within the intermediary relationship, right? And even the beneficiary and pass-through accounts. So while the industry concentrates 80% or 90% of compliance resources on initial customer onboarding, I mean the KYC, money launderers exploit the structural, the kind of unclear of the nested correspondent chain, that is where the intermediary bank cannot see the underlying originator, right? And take, for example, it's like saying in a nested correspondent bank, right, where bank A, because sometimes when I'm trying to give or explain things, I like to give a very vivid and clear example. So it's like saying where bank A clears through bank B to reach bank C. Now, the risk on that bank B, which is the intermediary, so it acts as a blind conduit, because the upstream originators frequently use a generic ledger clearing accounts, cover payments under SWIFT and all that. So that actually obscure the true source of fund, right? So the risk is still sitting more on the intermediary relationship.
And so, Mr. Emmanuel, my second question is, what specific information or behavior should cause an institution to pause a cross-border payment, even when the customer is like, I want instant settlement? What behaviors or information would you perceive as suspicious that will cause an institution to pause the payment?
All right, thank you for that question. Actually, there is this general soft flags that most institutions are familiar with, and in a near instant payment, soft flags like unusual amounts, right, are basically useless at this point. So pauses must be driven by a kind of hard structural mismatch. Take, for example, structural mismatch in the sense that legal entity identifier database validation, right? It pays, the database validation for legal entity identification oftentimes fails. Failure in the sense that not the system, because if there is a system, they would have mitigated a whole lot of factors. But some doesn't even exist. And for those ones that exist, probably due to cost, they are not applying. And also, as we talked earlier, unverified intermediary like the BIC routing and a high velocity round tripping across the non-jurisdiction within minutes. It's like saying you are sending funds from the US to UK, not a US to US based transaction, right? And it happened concurrently. So let me quickly speak on the legal entity identification, right? When an ISO 20022, it's just more on the global payment messages, right? So a payment message claims a corporate identity, but real-time API verification against the Global Legal Entity Identification Foundation, that is the GLEIF, the database, shows an expired legal entity, right? And if there is also a mismatch in the corporate address or a dissolved corporate status. So these are part of the important behavior. Can you see now that the behavioral pattern has actually gone far beyond the usual amount of transaction, which is kind of a common rule or a common factor that most financial institutions will pay higher attention to, and they begin to file suspicious activity report and suspicious transaction report, as it will be called, right? So just as I've said regarding the intermediary routing BIC, right? Like sudden routing changes where a payment stable corridor, like maybe UK to UAE, for example, is unexpectedly routed through another high-risk BIC. So these are one of the behavioral patterns that should be closely looked into, not just the usual one that most financial institutions are actually familiar with. And lastly, looking at the round tripping, that is an account receiving multiple incoming cross-border wires from distinct geographical originators that immediately triggers an outgoing instant payment of 98%. That is, fund comes into a recipient account and immediately the funds doesn't sit in such accounts. When it comes in, it goes out. When it comes in, it goes out. And transactions like this, permit me to say, are more common with an aggregated value to a foreign, more of like a crypto exchange or a high-risk jurisdiction within 30 seconds. So this type of round tripping and also a kind of sudden change in routing number, the BIC, and verification of whichever legal entity that are involved in the transaction. And lastly, I would say structured address degradation, right? Because I have to write this down. So it's an automated stripping of unstructured beneficiary address. It's like saying when a transaction is consummated, for example, we are talking about cross-border transaction. This is not local transaction. Like, transaction is consummated successfully. And when transaction is consummated, the beneficiary address that you'll be seeing, right? If your IT could do a proper setup to look into, you will see locations captured with only the country name or the IP address, no further details. So these are the behavioral patterns that should be looked into rather than the unusual amount of transaction patterns that locally we are more familiar with.
My next question is to Mr. Sanmi. So you spoke extensively on nested relationships, so nested correspondent banking relationships. Now, how do you solve the channel of nested beneficiaries? Do you have any suggestions on how we can, or financial institutions in this space can determine their ultimate beneficiaries? Over to you, Mr. Sanmi.
Okay, so thank you for that follow-up question. All right, Adela. So basically, the way we can solve it is by actually knowing end-to-end the folks that are involved in that transaction, right? So even if the ownership structure is opaque in any way, right, or the ownership structure is from it's complex in itself, we must unravel till the point where we understand or know who benefits from the transaction that is being consummated at that point in time. So in compliance, there's something we call RFI. You can raise RFIs on that transaction if you are not comfortable with the information that has been shared with you, right? So you may request for things around, okay, so provide the agreement that was used to consummate this trade. You will validate the economic rationale of the transaction purpose that has been set. You want to understand the relationship between the parties, like address validation. There are multiple nuances that can be used to demystify or declassify to the point whereby you know who the actual UBO is. It's still a struggle within the industry, right? But yeah, we can only work with all of the relevant information that we have to punish ourselves from being used as a conduit for money laundering, right? So you will continue to ask questions until you can prove beyond reasonable doubt, right, that whoever or who the parties are that are involved in that transaction, right, actually makes sense. So for context, there's a transaction moving from, say, Nigeria to UK, right? Trying to buy, say, a house, something like that. You are trying to buy a property, right? So of course, the amount is going to be, say, averagely, because it may be a down payment between 50 and 100,000 pounds, right? Down payment, because you have been subscribed to mortgage. You need to ascertain the source of funds. You need to understand the occupation of that person that's even starting out the relationship to begin with. Like, how did you even come by the property? You want to, like, you're assessing even statement of accounts, to be honest, right? Because how did you come by the funds? Can you provide evidence of how you came by the funds? Like, because you're trying to build credibility on the transaction chain in itself. So that's one of the ways whereby a nested flow can be demystified to the barest minimum. But yeah, in my vernacular, right, so there are equally ways whereby all of those things can be gained and whatnot. But yeah, so that's the best answer I can give you at this point in time. Thank you.
I'm going to be truthful. Yeah, it's a work in progress. It's going to be a work in progress because it's not something that is machinery solved. It's human judgment and human thinking. Like Sanmi said, you would raise RFIs, but let's not forget that people are prone to generate fake invoices. People are prone to generate fake agreements in order for them to scale through that RFI. However, for compliance professionals, it's I think it's doing your best. Anyways, it's because people will always find a way to try to beat the system, try to show that the transaction is valid. For sometimes, people have given invoices, and when you do the calculations for each of the products, you realize that the sum doesn't even add up. They don't add up, and you tell them, look, these transactions, the amount, the cumulative sum, and whatever doesn't even add up. It doesn't make sense. Okay, can we see the agreement for these transactions? And somebody's giving a one-pager agreement and telling you, oh, this is that. So it boils down to how detailed a compliance professional would always want to be, because people would always want to push your system. People always want to generate those documents. And once they do it the first time, it doesn't go through. They go back, try to improve what they've given before and bring back. So it's your judgment, and it boils down to maintaining the highest professional standard. I think that's the only way this can be dealt with.
Still with you, sir. Where a payment crosses like multiple jurisdiction, sanction regimes, reporting thresholds, risk tolerances, how does an institution determine which standard to apply?
Oh, okay. For us in Nigeria here, the licenses you have doesn't really matter. It is the rails you have that matters. The correspondent rails you have to provide those services is what really matters. Yes, you need the licenses to operate legally, but if you don't have the rails, the correspondence to deliver your services, nobody's going to use you. So what I would say is, for us in Nigeria, whatever correspondent services we want to use, bankings and the rest, they have their desired standards to meet, which is usually higher than what we have here in Nigeria. So it is really not dependent on whether you are in Nigeria or not. It is dependent on meeting the standard of what you have, and I will call it the most stringent standard. And Nigeria is not the most stringent standard. Yes, you might have your licenses, but you need to be able to meet their own standard and be able to, assuage to their risk appetite to provide those services. So I would say the stringent standard is what is preferable, not necessarily the Nigerian standard. The stringent standard would meet and surpass all the, sub standards which are not as high as possible, but it makes you to meet all the other required specifications. So I'll say the stringent standard, which usually is not the Nigerian standard, but the stringent standard. Thank you.
Okay, sir. And so what evidence is what's this standard? What evidence should, let's say, a correspondent bank, need to see? Like, let's say the bank with the stringent standard, aside your licenses, aside your policies, what else do they want to see to show or to know that you're indeed compliant and your AML and CFT controls are in place?
You need to do an independent audit, provide an independent audit of your processes, your compliance checks, your policies, and apart from your normal general searches on UBOs for your entities, but there has to be a verifiable and respectable independent audit of your processes. What I mean, your processes, from your onboarding to how funds are dispensed to beneficiaries. And it's a little bit, how should I call it? Technical. When I mean technical, because for some entities, it's not really about what you have on paper. They want to see what you've delivered before, and sometimes it still comes to relationship with each of those entities. Like for myself, for about 2 different entities, it has really come down to how much somebody in your team has performed with a different entity and shown that they are willing to meet and maintain such standards at the same time. Even if your audit report is there to show that, your processes have been audited and they meet the required standard. Sometimes the human relationship is very vital, especially when you've provided such services to a third party who is aware of, the current relationship and the rest of that.
Mr. Emmanuel, I want to ask you this next question. For Nigerians and for financial institutions, I mean, one of the selling points aside competing transaction fees, the speed of payment, just like Dr. Tunde said in his introduction. And so what I want to know, or what I want to the members, the audience on this call to know is, have payment speed advanced faster than the compliance controls supporting them? And in your expert perspective, what do you think, or where is the gap most visible today?
In fact, I will say yes, right? I will say yes because, the payment system, the payment rail has evolved from this kind of batch processing, which is more like synchronous batch processes, into a sub-second instant settlement, right? So, and looking at the compliance algorithm, compliance screening algorithm, it still rely on this asynchronous, a kind of fuzzy matching and batch sanction update. So the gap is mostly visible in the total failure of post-settlement clawback. It's more visible in before processing the transaction. Now, this is what I mean, right? Adding more human compliance analysts. Let me break it down in that way. Adding more compliance human analysts cannot solve a sub-seconds problem. That's just the truth. Because payment process now, the speed is very fast, right? So the solution actually require a shift in a compliance process whereby this may actually be difficult because things like this would affect, there's always a friction between the business, operations and compliance when it comes to things like this, right? So there should be a mandatory real-time pre-validation at the payment initiation stage. In some corridor, when a cross-border transaction is to be consummated, take for example for US, I think there is an electronic transmission rule that allowed, once a transaction has been processed, there is a pre-authorization, let me use the Nigerian language, a pre-authorization lien, right? It's like you hold the transaction for like few seconds, maybe let's say 30 seconds, maybe 1 minute, 2 minutes, 3 minutes before completing the process of that transaction. And within this period, there is possibility that an alert could be triggered, that there is a suspicious activity going on. Most financial institutions within Nigeria even do receive notifications from NIPS asking them to confirm the authenticity of this transaction before completing the settlement, right? So the bulk, that's where the gap is. And to mitigate it, I would rather encourage a mandatory real-time pre-validation at the payment initiation stage before the payment is ever injected into any clearing rail. So this is just the gap, but it's a very strong friction if compliance are to implement a system like this to help mitigate the risk of money laundering, financing of terrorism, or any type of illicit fund movement or fraud, right? But it is really necessary because this will help facilitate and manage the trend, or let me use the word, it will help reduce the risk of money laundering and financing of terrorism. based especially on some kind of transactions that are more bulky, incessant movement of transactions. So this is actually the gap, and the best way to mitigate it is implement a mandatory real-time pre-validation, but I doubt if that exists in any financial institution as at this time, because the competition in the ecosystem is high.
Okay, sir, and why do you think it doesn't exist yet?
All right, so there is what we called if the board or the management are not really setting the tone at the top, it's a very big friction or a kind of strong constraint for the compliance to implement. So one of the issue is sitting with the board if they are not setting the tone at the top. I mean compliance tone at the top, right? So if they can set a compliance tone at the top, it will be difficult for compliance to implement, right? So one of the ways to solve this is ensuring that the board were able to set the tone at the top in case like this to ensure a real-time pre-validation, right? And the real-time pre-validation, you can apply based on the business risk appetite, right? If your risk appetite can only take like maybe let's hold on for like 1 minute, 1 second, 30 seconds. Some you can even take as far as 30 minutes, depending on your risk appetite, right? So the most important thing is the board setting the tone at the top, and
right.
the compliance tool should ensure that the recommendation was pushed forward to the board.
Mr. Emmanuel, thank you so much for your insights. I think I had a question because I'm curious. Once again, I'm not an operator. I'm a supporter on the side, and I know that obviously I engage with a lot of people in the space, so I know that this tension that you speak of between the business and compliance is a real tension that always exists. I mean, and it will always exist. The question I have, when you say I think the way you couched it was mandatory real-time revalidation. And I guess I just want to be clear that you are just basically requesting what you're thinking that the solution is a bit of a delay on the consummation of value, while the compliance team is doing the necessary checks that they need to do in place. And I just want to confirm that's the suggestion that you're putting in place. I guess the second part of that question was you made a comment around clawback. Maybe I misheard it. And I think that's actually an interesting solution to the problem, because the problem is the people want it to go fast, but if it goes fast and is left, then how do you get it back? So are you seeing any institutions, or have you worked with any institutions where a clawback is a viable way that they've been able to manage that kind of risk? So that's my questions, and I guess it's for you, sir, because specifically you mentioned it, but Sanmi and Peter, please definitely feel free to tag on that.
So let me quickly answer that, right? Yes, that's what I'm referring to. And talking about the clawback, right? On the legacy correspondent bank, right? I know you want the answer to be centered on a local transaction within Nigeria, but let me start with cross-border first, right? So the payments can take like 2-3 days, right? So let me use maybe 1 hour, 30 minutes before. So before leaving a buffer window to intercept any flagged funds. So in the instant cross-border settlements, once funds lands in a receiving bank account, foreign legal protection makes clawback nearly impossible, because the transaction is crossing is from a particular jurisdiction to another jurisdiction. So in the US, I think I'm familiar with this. It takes like 30 minutes, right? And even when money laundering is identified, 10 minutes even when money laundering is identified within 10 minutes post payment, right? So it means that within that period, it's still easy to salvage whatever situation it is, right? But currently in Nigeria, the friction between the operation and compliance is always there. So everybody wants to get it done instantly. And that is why you discover that the analysis and trend of fraud, in fact, I can specifically tell you that if you should conduct a survey with any financial institution across board, recovery of fraudulent transaction, the chances are always very slim. And the reason, one of the major reasons behind that is always because there is no pre-validate. In fact, traditional bank, let me use commercial banks, not even the fintechs or the licensed MMO and the likes, right? There is something we call pre-authorization lien. So when a transaction is consummated, there is a pre-authorization lien. You know, within that space, if there is anything, if there is any concern, you can easily salvage the situation. But now the competition is becoming high, and everybody wants to do business, and the risk of the bad actors engaging in AML, in money laundering, illicit movement of funds, and transactions that are fraudulent, financing of terrorism, it's becoming something that one can easily, that can, in a speed, in a very millisecond speed, transaction can be consummated easily. So basically, that is what it is.
Very much. My name is Akem Adepoju. Emmanuel, well done. Yes, I just want to add to what he just made mention of. And again, it's more like a devil's advocate. So sometimes in rates, I think there is also a need for us to be able to also appreciate and admit that business and mandate and our mandate are not the same. So you are literally not going to be on the same page. There's nothing you do that will make them to align with your position. And in my own experience, even till where I work, so I've been able to first settle with that, have that peace of mind that trying to align is a waste of time. And some things you are not going to get it done because every business is set up first to be able to break even, make profit. And essentially, control will never allow them sometimes to break even or make profit. Simply because they will tell you it's a fundamental principle. The higher the risks, the higher the return. So, and the piece I made with myself is, they will also tell you in risks, know how to transfer risks when something goes wrong. Where you shouldn't be found wanting is, have you told us? Are we aware? Have you been able to dimension that if we do this, this is what will happen? And if it happens, there's something like, oh, we are not aware. We need to now start transferring that risk and document it. Because the truth is, I'm not aware there's any institution today in Nigeria that will allow your control to screen transaction instantly. You know what will happen? Like he mentioned, your competitor will leave you behind. Today, we know some people will tell you, if you want your money to get to you, just send it to this account. Because even before you press send, you receive it. And because our culture in Nigeria today, averagely, we are impatient set of people. Forget whether you are even a fraudster or not. A lot of us, even legit customer, you want your money now. Like you are not even a fraudster. You are already telling the person, I'm not getting alert, I'm waiting for alert. So it's not even because he's a bad actor. It's just a culture of, I want it now. We don't have patience to allow things to take normal process. We just want to jump. And so it means even if you put control in place, trust me, how many illegitimate customers do you even have? What will be if the total of fraud that you even see, sometimes will not make business people to want to allow you to put control in place. So the piece is, you recommend, you document, let them know, let them be aware, transfer the risks, do what you can do, and let them know that you've given them the best advisory solution. But again, I also want to add that I left, deposit taking institution as a result of the fact that you are constantly unable to sleep. You are basically thinking like a fraudster. And inattentively, if you are not sure, you just realize that you can't catch this guy. So I left that space. And trust me, since I've left, the peace of mind, no, I don't want to go back to where some of my contemporaries are. I honestly speaking, because these guys, you just have to be God for you to catch them. Regardless of any solution you put in place, they will still, it's like they are born to be destructive. So the reason why the piece I just want to encourage most of us is, let's just learn how to document, learn how to let them know that we can't. I don't believe in alignment anymore because their mandate is different. Just document, transfer the risks, do the best you can do, and recommend the best solution you can recommend. But trying to be forceful or risks is part of everything in life. It's not just financial space. So it's just like an addition to what Emmanuel was discussing before, that regardless of the fact that traditional banks were doing this thing before, none of them will want to do it anymore because the fintechs has taken over retail from them, and you see them fighting back. And the way to fight back is to start doing what fintechs are doing, which is, I will not block you. You want to be faster, you can go ahead. After all, I'm not the only one. So it's a case of the control guys, just continue to watch our back, but don't stop us. Thank you very much.
I don't know how to say it. Yeah, your experience was how should I call it? Was okay, entertaining, but at the same time, it gave a lot of insight. But however, we should all know as compliance specialists that we are not just policy makers, we are enforcers of those policies. And in saner climes, when things go wrong, the compliance officer is not left alone. We are supposed to not just enforce, we monitor how those things are being carried out. Also, I want us to also know that for conventional banks, yes, it can be different, it can be instant, but I don't think there is cross-border payment platform that does instant payments. The reason for this is, number one, you don't want to burn your rail because your correspondent bank is expecting that you have put a lot of checks in place not to burn them because the payment is going through their own platform. So you are expected to maintain a level of professionality because they are also doing a check on whatever transaction is coming through your own platform. And if they realize that a lot of red flags are coming from your own platform, I'm telling you, you are going to burn your rail, and it may be one of your most important rail. When I mean the correspondent banks and whatever you have outside of Nigeria that's helping you process those transactions. So whether or not for conventional banks, yes, it can be like that. But for us here, when you don't put those checks in place, in fact, like I said when I was commenting on the question, I said sometimes we review those receipts, those invoices, and you see that they don't even make sense because when you do the calculations of how much is being paid for a product, it doesn't add up. And if those flags go through us and go to our correspondent service providers or partners, and they're asking us, why is this coming here when it doesn't even make sense? It means they are looking at you like you are not even reliable to do enough. So you want to make as less as possible to go off your table for them to actually, raise those red flags. So it's better to deal with them before they get there. Like I said, this is not for conventional banks, for cross-border payments. So you want to maintain your reputation, you want to maintain your rail, you want to maintain the only thing that makes you provide the services you have as it is. But also, for business persons who are telling you to make those payments, if those rails get burnt, they don't have anything to do with, and it's your fault because your compliance has not been up to par. So I would say once again, there is a regulation for it. There's a legal consequences for it as professionals, because if those payments go through and you are termed as aiding money laundering, as a head of compliance, it's you can take the fall for that too. So I want us to put that into perspective. Thank you very much.
My next question is for Mr. Sanmi. Do you think, as someone with vast experience, across, various payments and, jurisdictions, now, do you think that transaction monitoring and sanction screening systems are genuinely designed for cross-border risk, like in current Nigerian cross-border landscape? Like, do you think the transaction monitoring and sanction screening systems that institutions currently use, do you think that they are genuinely designed for cross-border risk? And is it possible to apply these domestic controls to a more complex regulatory global environment?
All right, thank you for that, Adiola. So basically, right, maybe because of cost, right, most institutions are still running domestic control philosophies inside an international payment ecosystem, right? And when you look at domestic monitoring itself, right, what it prioritizes is velocity, thresholds, and account level behavior. But in cross-border risk, right, it's another beast entirely. Do you understand? Because multiple institutions are involved. There is corridor risk, there is payment chain structure, corresponding banking relationship risk, just like Peter had alluded to ab initio, right? Like, there are a lot of flows. There's FX activity, there's trade flow, there's geopolitical developments. Like, you need to understand the nuances, right, in total for you to even be able to build that robustness in place. So what that implies is financial crime in itself has moved from isolated transactions to interconnected payment ecosystem. So that monitoring adherence in itself has to be at that same level. In essence, what I'm saying is they are not the same and they can never be the same. You understand what I'm saying? So with that said, our monitoring architecture as well needs to be at that level. So you are looking at behavioral AI, entity resolution, network intelligence, and the likes, right? So whilst sanction screening has matured faster than transaction monitoring on these fronts, right? Because everybody wants to protect its own license. Because remember, there's a direct linkage when you allow any sanction transaction to go through you, right? Then that direct linkage that there's a possibility that the license can be revoked. We all know that, right? Even there, most institutions are still running list-based screening logic, right? Because how many sanction screening systems do we have today that can run multiple languages? So can run Arabic, Cyrillic, and the likes, right? How many systems do we have that have that capability? We are not a lot. So what that implies is there's underinvestment, right? Which points to the weakness that we currently have at industry level that is beyond maybe even fintechs and whatnot. So the structural shift that is expected is static rules were built for isolated transactions, right? But financial crime today, through our ecosystem, right, monitoring has to move with it. Do you understand what I'm saying? So yeah, that's my response to that.
To me, they are not enough, right? And the reason why I would say they are not enough is because every jurisdiction has their own. Every jurisdiction have their own regulatory bodies, and these regulatory bodies come up with regulations and policies that aligns with the operations of the financial services within the ecosystem, within the economy of that particular jurisdiction. So it does not, to me, it doesn't 100% apply to the global stage. Reason being that there are some factors that needs to be looked into, and these factors are not limited to identifying the high-risk region and also understanding how their regulation actually operates within that system. Take, for example, in the UK, there is a regulation that came into effect 2 years ago, and the regulation addresses authorized push payment fraud, right? Now, there are principles, there are guides regarding that, and it has really helped within that region to mitigate a whole lot of risk. Now, imagine a transaction that was consummated from the UK, where APP fraud regulation is effective, right? And every financial institution within that region had to look into their existing rules and be able to tweak one or two metrics in order to align that they were able to detect any suspicious transaction relating to authorized push payment fraud, right, within their region. Knowing fully well that the authorized push payment fraud regulation does not apply to some regions in Africa. Let me use some, because I'm using some because it's only recently that a draft of APP fraud was released by CBN. Meanwhile, I'm not sure if it has gone into approval fully yet. Meanwhile, in the UK, it's fully effective for like 2 years down the line, right? Now, looking at the regulation and the way and the metrics behind how we conduct our sanction screening, how we conduct how we tune our transaction monitoring metrics, right? It can never be the same as the one from the UK because of this regulation. So it's not in all cases, but however, it doesn't apply 100% globally.
My next question back to Mr. Sanmi, and if you could, if an institution wanted to strengthen its cross-border controls within like the next 12 months, without slowing payments, so you want your controls to meet the global standards without slowing payments, what's the first change you would recommend?
So my first recommendation would not be to even buy a new tool, like if I'm being honest, right? Because the problem in itself is beyond that. I would rather build the foundations up, right, from the perspective of an enterprise payment intelligence framework, right? Because I can drive faster evidence from that angle in the guise of, say, remember, there must have been historical records, because for every tool that we have out there is basically all of the information or data points that you set in place that the thing gives you feedback afterwards, right? So it's a case of garbage in, garbage out. So that is the problem that an enterprise payment intelligence framework will solve, right? Because it's going to integrate multiple parameters into it. There will be historical customer risk, transaction behavior, payment corridor risk, sanctions exposure, corresponding banking risk, and whatnot. Because we've all mentioned it at some point on this meeting that what is permissible by a payout partner A may not necessarily work for a payout partner B, right? So that in itself is crucial in the understanding of the data point that must feed into the framework, because it is that framework that will now establish the basis for which we will start building for the next 12 months. Because what we are selling, everybody that we are selling is beyond faster payments, to be honest. Trust in itself, trust in the ecosystem is the highest level of selling points that we have. And until we crack it to the extent whereby analysis can happen real time, right? So whilst payments can happen real time, online real time and whatnot, risk acceptance does not necessarily have to happen real time on the online real time as well, right? So those data points, like I've alluded to ab initio, will need to be critically assessed, right, to the extent of the risk appetite that the entity in itself has, right, in connection to what it is building to solve. Whilst we all pay within the payment space, we are solving different problems. So to crown this, my approach would be to have that framework in place and build from ground up into it, and ensure that all of the data points that we are using will give credence into what is being built, and operate from a position of resilience as against anything goes. Thank you.
And from your perspective, or in your opinion, if you could improve the quality of like 3 data points in the cross-border payment space, which would you choose and why? And this question cuts across other panelists as well. Thank you.
Thank you for that. So immediately you asked that question, one acronym came into my brain, UGV, right? And I'll tell you what UGV means. Because if you can solve UGV, all of those additional information that flies around becomes next to useless, right? Because patent recommendation 16 already says that travel is yes to stay and whatnot, and is equally being corroborated by ISO 20022. Whilst adoption may not be global yet, maturity level equally comes into play. So UGV, right? Ultimate beneficial ownership, basically, right? Knowing who ultimately controls the value in that transaction chain is the single most effective financial control that is out there. Because ownership transparency directly addresses shell company issues, sanctions evasions, right? And it's still the most commonly falsified information that you have, especially from a complex ownership structure and all of these nested relationships that the payment ecosystem is equally exposed to. Number 2, that cannot equally be left out of the room is genuine economic purpose, right? Everything we do or we validate based off all these invoices that are presented to us, agreements that we are using to corroborate transaction consummations and whatnot, right? Payment purpose should describe the actual commercial rationale, not all of those generic shenanigans that our beautiful people in first line are known to always share with us. Something like, you see, payment for service. What service? Service to cut off somebody's head? Or payment for consultancy? What consultancy are you doing? To cut off another person's ears? Like, those things are so generic, and at times I lose my cool when I see those things, because it'd be like, I've traded you $1 billion at one time, and you're still bringing this to my table. Like, it's funny, right? So number 3, V, and a couple of panelists has equally alluded to that, is that verified originator and beneficial identity, right? Legal entity identifiers, validated addresses, national registration numbers, and tax identifiers where applicable, because those numbers in themselves, they are a unique data point or reference point when it comes to validation, right? And it equally cures that limitation that ISO 20023 is known to have, which is, once it relies on adequate information and robust information, right, it has a limitation around synthetic identities. So identities that are formulated, how will it just for it to input number now? It's messaging. So that limitation exists in that angle, and equally, maybe there is weak internal control process, corruption and whatnot. Those weaknesses apply to ISO 20022. However, when we enshrine the culture of using verifiable and auditable identifiers, right, we build a strong defense point, right, from our respective systems, from being used as, say, conduit of meals for money laundering, or maybe TFPF as the case may be, right? Because remember, whilst compliance can be, say, a blocker, we are reviewing a transaction and whatnot, right? Try, like Emmanuel Wilcoli said, try recovering money from sophisticated criminal networks. So what that implies is those data fields must be correct and validated, because remember, there's called that principle of you can trust, but you must verify. So in all of these things is to ensure that all the data points that we have are verifiable and auditable, as the case may be. So thank you so much for that.
this is a follow-up question from our audience for Mr. Sanmi. So it says, the G in UGV for generic, do you subscribe to the idea of template purposes? Because further context, I used a money transfer service that has a drop list of about 20 or so purposes for the transfer of funds. So does that solve the problem or create another problem? That's for you, Mr. Sanmi.
I don't believe in drop downs. Why am I the one suggesting what's your transaction, the transaction that you're trying to consummate on my platform? Why am I the one suggesting it to you? Right? You should tell me, because I'm supposed to sit at second level to ensure that what you are trying to put through my system is actually legal and genuine and has what's that thing called, justifiable economic rationale behind it. So I'm not a fan of that, and I technically won't build or allow my product managers to build that into any product within my coverage. Thank you for that.
All right, sir. So, Mr. Peter, over to you now. If you could improve the quality of data points, which would you choose and why? Of three data.
So generally, I'm going to build on what Sanmi said. Generally, it's the same problem everywhere. We want to have the same information that is verifiable. So for me, I want verified beneficiary identity. You know, we don't want stacked payments, a nested payment where we don't know who the ultimate beneficiary of every payment is. So if I want to improve that, if I want to create that, it's going to be having a verified beneficiary, not a nested beneficiary for every transaction. Then also purpose of payments. Generally, we understand that by CBN regulations, every USD transactions or exchange has to be transaction backed. It means there has to be an agreement, there has to be for particular services and the rest. So, like I said earlier, people bring invoices that don't even tally to what they intend to make payments for. They try to generate agreements that are falsified in the real sense of it and the rest. So if there is a way to, you know, have a verifiable purpose or nature of payments for every USD cross payment services, it's going to do a lot of work. Is the, you know, the burden to scrutinize every agreement page by page, the level of signature, whether duly executed, the dates on each agreement and the rest of that. So that will go a long way for me. Then lastly, ultimate source of funds. Getting that is as key as onboarding every client, because getting how you intend to put money in the platform, then push money to your ultimate beneficiary to its destination, having to verify that source of funds is also key, because when people tell you this is the source of funds, because you are limited with resources, it's very difficult for us to verify those source of funds. Some tell you they sell houses, they've sold houses and the rest of that, because those houses are not generally documented at the land registry. It's difficult for you to actually identify whether or not those houses exist in the real sense of it. So people do a deed of assignment and push it to you and say, oh, this source of funds, I sold the property somewhere. And but of course you understand that not every property is registered at the land registry, and validly so. The argument stands that, oh, it was not registered, it's an inherited property that has been for a while, but I just want to sell it off and the rest of that. So I think ultimate source of funds is the last key thing I think I would want to improve.
All right, so I will address the three data points that they've talked about. So, and they've spoke extensively on it, but briefly I would just say that verifying the legal entity, right? And also structure. All right, so I would say verified legal entity, and also fully structured beneficiary physical location. You know, the ISO 20022, right? The legacy payment messages frequently lists vague strings, you know, strings like London, Dubai, or some will even omit the address entity completely. So a fully structured postal codes and the ISO country code, it really allows screening machine or engine to pinpoint any high-risk sanction region. Something like targeted export control zones, right? And without stopping thousands of unrelated payments destined for non-sanctioned streets or sanctioned cities or sanctioned location poses a very high risk. So the beneficiary address location should not just be a list of vague strings, right? And the third one is the purpose of the transaction, right? So purpose field that, they are currently filled, just as they've said, filled with useless fillers like payment for services. In fact, some will even have, they will write SALA, which the full meaning would be salary, right? Supplier, SUPP, a whole lot of things like that. So what I will advise when it comes to the purpose of transaction is there is a way we can develop a machine learning model that would dictate the contextual behavioral anomalies on customers' accounts, such as individual accounts receiving high frequency payment inconsistency with their profile. So take, for example, in fact, most banks or fintechs don't even apply this. In the CDD regulation, part of the KYC requirements to onboard the customer, they requested for the social media handle of the customer. But how many financial institutions are actually requesting that, please drop your social media handle or your social media handle link, right? So imagine we are collecting this data, right, as stipulated in the CDD regulation, I think the regulation 2023 or so. Now, if the social media handle, right, the customers probably at onboarding, part of the questions we ask for the financial institutions that do ask some further questions, and customer says probably declared his occupation, and the occupation he declared happens to be a financial advisor. That's crazy anyways. They will say I render a financial service, a financial advisor. That's not detailed, but the social media handle provided has no connection with being a financial advisor or being a web developer or being a farmer in any way, or being someone who sells item online, right? They will even go ahead and even provide a wrong social media link. Now, these are profiles that you can now, the system learning language, the model can now look at the behavioral anomalies as against the customer's profile. So this will really help without just depending on the purpose of transaction stated.
All right, sir. Thank you so much, sir, Mr. Emmanuel. Thank you so much to everyone